And now, with Sound Investing, here's Paul Merriman.
Well, I don't know how many times I have said, this is probably the most important podcast I've ever done. But let me tell you, when I think back to what our then very, very small organization was in 2012 when we started, we had nothing. We had I think 3 books that we were offering free to people, and we're doing a podcast. We didn't have tables and all sorts of studies that Daryl and Chris have done to make our followers much, much better investors. And today, I really think we're putting the cherry on the top of the cake because we have been delivering to you the ultimate buy and hold strategy update every year for ever since we started this process. We have been updating, fine tuning your asset allocation. And I can tell you, Daryl is working on the rest of these tables and they're coming out soon. But the bottom line is, we got one that while we did touch on it last year, that is a must to update. And part of the reason is because we did, I think about a year ago, if I'm not mistaken, Daryl, we did a no nonsense portfolio study that showed a bunch of different strategies. And then I was asked to speak to the White Coat Investor Conference a few weeks ago, and I chose as a topic an article they wrote about in 2014 entitled 150 Portfolios Better Than Yours. And that is actually now up over 200 portfolios. But Jim Dahl, the person who runs the organization, decided to keep the old title because so many people came to it on the internet. But it's over 200 portfolios. And the concept is that any of these portfolios are likely to do better than yours. And so what I wanted to do, I wanted to dig in and give these people information about those portfolios so they would understand some of those portfolios are built to make 10% theoretically. Some are meant to make 11, some 12, some even more than 12. And I'm not sure those folks are aware of that background. So Daryl, as always, came through like a champ, produced some tables for me that I could present that not only showed an update to the no nonsense tables, but also the new pieces on this 150 portfolios better than yours. So now we're going to put that information to work. And I think you will walk away with 3 to 10 new lessons about the understanding how investing truly works and helping to create what I think is one of the most important aspects of becoming a successful investor, and that is to build reasonable expectations. Because if you assume the wrong expectations, you get yourself in trouble because things just don't look right when they are totally right. So Daryl is here, Chris is here, and I'm going to lean into these tables and then we're going to discuss them. And at the end, I think it's going to be a super conversation. In fact, it may be a separate podcast altogether, but we're going to dig into the question, which portfolio is best for you? And we got a whole bunch of different kinds of investors that follow our work. So we'll do our best to sort through those and help you pick the right one. So, gentlemen, thank you for joining me. I'm going to go ahead and pull up the starting tables here. Let's see. Yeah, there we go. And that's the right one. All right, here we go. What we did initially was build a series of tables. And the purpose of these tables was really to investigate these different kinds of portfolios. Many of them you'll recognize because they are the very portfolios that we use for the people who follow our work. But we wanted to go beyond that. We wanted to go into these tables, other tables that are very commonly assumed to be kind of the best to be that there is. For example, as you look at table 1A, by the way, I hope that most of you will be able to see this as a video, and I'll be careful, and I know Daryl and Chris are always careful in this regard, to try to make it usable even for the person who is listening to the podcast. But I can tell you what we're looking at right here. It's a table that shows a series of 1 fund, 2 fund, 3 fund, and 4 fund portfolios. And the only thing we're looking at are the equities. We don't care about the bond portion because that's a totally different problem for investors. We want to focus on, to the extent that I have equities in my portfolio, what combination of equities are likely to treat me within my need for return and within my risk tolerance. So what do we got? We got the S&P 500 as the single equity position. We've got the U.S. total market. That would be the total market fund, for example, at Vanguard or Fidelity. But it is a cap-weighted portfolio of more than the S&P 500, typically around 3,500 securities in that portfolio, all U.S. Then we've got the total world market portfolio. Now, the total world market, you can actually buy that, is basically a combination cap-weighted, which means whether it's the U.S. or the internationals, wherever the highest value of these public companies are, that will determine what that weighting is. So it's not a 50-50 split. It will be overweighted to that part of the world securities that have the highest value. Right now, that would be U.S. over international. And then we have the 2 fund portfolios. Now, remember, I said we're only looking at the equities. So when we look at the 3 fund equity, the 3 fund portfolio for Bogleheads, I'm sure a lot of you know that portfolio. That's some total market US, some total market international, and then a certain percentage in bonds. All I want to know is, how did the equity portion do? And then we have a couple of portfolios that represent something we made up in a sense, because I wanted to combine something with the total market indexes, both the US and the total world index. And I wanted just to include along with that some small cap value. We talk a lot about small cap value. So the question is, what would happen if you had a 70% total US market and 30% small cap value? What would happen if you had a total world portfolio and 30% small cap value? And then another portfolio is all US only. So those are all 2 fund strategies. And then we have a 3 fund strategy from Rick Ferri, and we have 4 fund strategies in this mix, 1 US only, 1 worldwide. And you've seen those 4 fund strategies often in the work that we do. And then an all value portfolio worldwide. So there are 9 portfolios. Let's see, maybe it's closer to,
11.
11. Yeah. Well, at 78, I'm having trouble counting. And by the way, my sight is failing too, so I may call for help here. So here's what we then did. We determined, using the dimensional indexes, dimensional funds indexes, that they take all, in many cases, all the way back to the 1920s. But we have these indexes for all the different asset classes that these different portfolios would represent. And so what happens if we then, excuse me one second here. What happens when, and by the way, Daryl, when I first saw this, I got so excited because it makes these hugely important points so vividly. In Table 2A1, what you see are the results of all of these different portfolios in the 1 and 2 fund categories. We'll look at the 3 and 4 in just a second. But Daryl put a green box around a series of these columns of returns. And what was inside the green box is, one, the compound annualized growth rate from 1970 to 2021. Also, by the way, it also shows the 52-year growth of a $10,000 investment in 1970. And then it shows what happened from 70 to 79, 80 to 89, 90, 99, 2000 to 2009, and then finally 2010 through 2021. So we can get an easy way to compare the results of these different portfolios. I love the easy one to look at is, what did the $10,000 grow to? And in the case of the S&P 500, that was 2.3 million approximately. In the case of the total market index, it was 2.4 million. So during that period of time, even though the returns both show 11.1%, the rounding gave the total market index an advantage. But the bottom line is the risk and return of the S&P 500 and the total market index are almost the same, whether you go back to 1970 or you go back to 1928. And then the world market, the total world market. Remember, over 2 million with the US, but when you put the world, the US and international together during that same 1970 through 2021, it grew to 1.9 million, a pretty substantial difference, about another $400,000 under the S&P 500 in the total market. And interestingly enough, about the same rate of return from the Bogleheads strategy, but the strategy that's 30% small cap value and 70% total market index, because as you've learned, I am sure, there is an advantage historically because it's more risky to small cap value. And boy, did that show up. 4.6 million for that portfolio versus the total world with the small cap value was 4.8 million. So both of those small cap value additions were hugely helpful. And then, just to make you salivate a little bit, we have remember, these are 2 fund portfolios, the equity portion, assuming an all US only value portfolio, half large, half small. And what do we see? We see almost $9.5 million, over 4 times the return of the S&P 500, either the total market or the S&P. Now that's a huge, huge increase. Now the implication when you see that, I'm curious, guys, when you see that big a difference in return, what are you assuming truly about the risk? What do you say, Chris?
Well, at one level, if you backed way up and you look at the chart, you would say it confirms the simple things that Fama and French's academics identified years and years ago, that if you invest in the smaller part of the market or the value part of the market over the very long term, your expected return is higher. And on a year by year basis, it doesn't necessarily pay out. There's periods of time here at the bottom where you would have been better off in large and better off in growth. And so you never know when the return is going to come, but over this long period of time, and even if you took rolling periods of time, many of them paid you back well for it. So even though the difference is small on a year by year basis, it's big when you accumulate it over the long term. And it's huge. You go from 2 million for it's all of the broad market with no tilt to small in value came in around 2 to 2.5 million. And the ones that tilted came in at 4.3 to 9.5 million, depending on how much they tilted towards small in value. So that's a huge difference across a lifetime, but it's the accumulation of small differences over long periods of time. And the risk, the downside risk, there is more. There's more volatility. I think for most people, they'll feel it more in drawdown or day-to-day variation in their account value, and whether they have the stomach for that or not, who knows, right? I mean, that's one of the biggest questions in here. Yeah. But it's always comforting to see that this observation made by academics more than 20 years ago still holds up.
Yeah.
That there's value in investing in these riskier assets if you can stay the course.
So that's great, Chris. And Daryl, I look at the standard deviation. When you look at the standard deviation, what are you assuming about the all value US in terms of risk? Would you expect that it would somehow be scarier to be in that all value strategy?
Yeah, I think almost certainly you would expect that. I mean, the reason, the expected return for the all value portfolio is higher. So you would think that, okay, the reason why it's higher is because there's more risk involved. And generally, eventually, the risk does show up. And so you would expect the standard deviation, I would expect the standard deviation to be higher as you go into the higher expected returns. So I would be curious about the volatility of it. But I would also be curious about where the volatility is. Is it on the upside or is it on the downside? And
Bingo.
So when you look at and I'm jumping ahead of you here a little bit, I guess, but
that's great.
When you look at the red boxes and you look at the worst down year, they're all pretty much the same. 38, 39, 40% for the worst down year.
Yeah.
But then when you look at the best up year, you see that, oh, okay, well, there's 37, 38. Oh, there's a 50, 37. There's a 46. There's a 45. There's a 56. Okay, so the upsides are pretty much higher. And that, of course, explains why the expected return is higher. So the volatility in terms of the worst drawdown and the best run up, if you will, on an annual basis, is the better run ups occur and as you're more tilted to the small cap value, which you would expect. So that makes me wonder whether or not the worst drawdowns that you see are really reflective of the bumpiness of the ride.
Yeah.
And whether or not that's really the case. And so then we can get into that a little later when we go down and we look at things like the Sharpe ratio versus the Sortino ratio. But
so
if I can, I think one way to rationalize that or reconcile it with what we know about the drawdowns being deeper for a portfolio that tilts more to small or more to value is that you're falling from a greater height. So, if you look at somebody who's been invested in small cap value for 50 years and has a larger portfolio here at the end than they would have had in the total market, they have more of that portfolio at risk, but they're falling from a much greater height. So one of the reasons the deeper drawdowns don't show up in this analysis is that sometimes the drawdowns take multiple years to accumulate. And so by only looking at how much you're down in a single year or up in a single year, you kind of miss out on the fact that after 3 years you might be down a lot more in an all value portfolio or a 30% tilted small cap value portfolio than you would be in a total world market. So
that's true, but I think when we look down at the decadal observations down below, when you look at the standard deviations and the Sharpe ratios and the Sortino ratios on the decade by decade basis, then you get a little bit more longer term view of things, and that should incorporate some of that multi-year run up or run down, if you will.
But here's what I saw that I just thought was so simple, and I'm not sure that what I concluded intuitively is legitimate, but I'm gonna at least try this. In theory, what we're worried about as an investor is not volatility on the upside. That rarely scares people, although a lot of people panic and think they better take their profit now before it goes back down to where it was. But generally, our concern is about losing money. And one of the things you did here, Daryl, that I don't know if I'm making I'm concluding something that isn't right, but you summed all of the losing years. In other words, the S&P 500 had 10 losing years. The average was about 14.6%, but the total, accumulating all of the losing years was a total of 145.9%. So in a sense, that was, if it all happened at once, obviously you're in big trouble, but that's what you had to live with over this 52-year period. On the other hand, if we look at the total US market and the 30% small cap value, there they also had 10 down years. But the total of all 10 of those down years was 123%. In other words, that portfolio was in essence, in that regard, less risky than the S&P 500. On the other hand, in the up years, and they both had 42 up years, the average return for the S&P was 18.4 versus 20.3 for the total US small cap value combination. So where the higher volatility came was not on the downside. The higher volatility, at least over this particular period of years, was mostly on the upside, which nobody, again, I think, complains about. So it made me think, have I worried too much about the downside with these diversified portfolios? So have I concluded something that for some reason is not right? Can either one of you call me to task on this one?
Well, I think the summing of the down years and the summing of the up years is you suggested that we look at this when we built this table, and I think that's kind of I don't see it shown that way very often. But one of the ways that I think about this is I think about, when you're looking at a hike or a bike ride in the mountains, they've got, the up distance and the down distance. How long are you hiking uphill and how long are you hiking downhill? And so this is kind of the same way, when they say, well, you hike 14 miles up and 22 miles down, and you think, okay, I'm going mostly down. That's probably better than going up in the long run. And here it's kind of the opposite. You look at, well, I'm in the S&P 500, for example, I'm going 446% down and 742% up. Well, that sounds pretty good, and then you can compare and contrast the paths you take, if you will, by looking at the up and down. Now, these don't translate exactly to how much you gain necessarily, or what your ending portfolio value is directly, because it's sort of, we're not adding anything here, right? No, so this is just an initial investment, so it doesn't matter what the sequence
Yep.
is.
That's right.
But it's an interesting way to look at it. I'm not sure the academics would necessarily find it of interest. Maybe they would, but I think it's useful for individual investors to look and understand what the differences are in terms of the up and down. And
And also, by the way, where you broke out the decade, the 10-year returns from 70 to 79, 80, 89, et cetera. I think that tells a tale as well that's pretty doggone important, because we never know where in our lives. I'm at 78. If I live 10 more years, what will they look like? Which of these decades will they look at? And I know they could look, and I'm looking at the S&P 500, they could look like a negative number for the next 10 years, or they could look like the 1990 to 99 and compound at 18.7% a year. But what I notice is for sure that the S&P 500, and by the way, this is a good lesson, it's an individual asset class, basically. It's large cap blend being some value and some growth, basically. But that's, if we call that a single asset class, compare that to where you have large and small and value, and maybe value and growth, where you have more asset classes. What you'll see is the decade returns become smoother. They are not as volatile. So if you look, for example, at the all value, by the way, that's just US, what it did in that same decade that the S&P 500 was down 0.9% a year was go up 8.4% a year. And so maybe more diversification, even when it comes to asset classes, are going to tend to give the investor more confidence along the way. Now, I could talk about, Chris, did you want to throw anything down on the table on this anymore before we move on?
Oh, just that I think that it's a great message for people who can invest like Rip Van Winkle.
Yeah.
If you can buy and then ignore, and just turn away and not pay attention to the ups and downs and the daily bumps, I think that the slide tells you should have very good outcome and you should feel good about it, and there will the downside will be swamped by the upside for having taken these prudent risks. The part that I still think any investor who tilts towards small and value needs to understand that's not shown, though, is the drawdown risk. So, but we capture that in other places.
Yep, we do. And it's very similar, by the way. It is a little larger, but it's still, I think, within reason.
It's quite a bit larger than the difference in the ups and downs shown here. And I think that's because it's monthly data and cumulative. Yeah.
Got it. I also want to mention that this particular period, because we always have to remember we're looking at a particular 52-year period. And the S&P 500 during this 52-year period compounded at basically 11%. It turns out, if you look at all the 40-year periods starting in 1928, the average compound rate of return was 11%. So we always wonder whether we're looking at something that is a special period or a below average or above average. It turns out basically average in this case. All right, let's move on and look at briefly. We won't have to spend as much time, but we still have the green, we have the blue, we have the red boxes to look at. And all of a sudden, I notice over here on the right side that there were a couple of strategies that had 43 profitable years and only 9 losing years. Now that becomes an interesting advantage. And it just so happens that one of those is the four fund worldwide, remember that four fund worldwide is 25% US large blend, 25% US small blend, and then this is the worldwide I'm talking about here. So it would be, I'll go back and say, it would be 25% in US large blend, 25% international large value, 25% international small blend, and 25% US small value. So it's the combination of large, small, value, and growth. But in both that and the all value portfolio, they had one more profitable and therefore one less losing year. And that served them well because, as you'll notice, the compound rate of return, for example, on the all value worldwide is 14%. The worldwide four fund strategy is 13.2. And by the way, so is the US four fund strategy, 13.2. And I can't help but notice that the $10,000 grew in the US strategy to 6.2, and the worldwide 6.4, and to the all value $9.1 million. So those are huge returns. And again, I don't want to be overly optimistic, but when I look at the worst, the accumulation of all of the losing years of any of those three strategies, and we have recommendations on our site for all three of those portfolios, that it looks virtually the same in terms of downside losses over this 52 years as the S&P 500. So I'm hopeful. I'm particularly thinking about the young people who have lots of time to go through all of these gyrations and hopefully not worry. I think people who are in their 70s and 80s might want to have more control than the kind of gyrations they'll go through. But it certainly creates, I think, a very hopeful picture. Now I'm going to go on to the next, in case you want to add anything, Daryl or Chris, to that page.
No, I'm good.
Good.
Just something we all know, but listeners may have forgotten. The worldwide four fund portfolio has historically performed very similarly to the worldwide ultimate buy and hold. So, so the positive things you said about that for people who are invested in the ultimate buy and hold, it has also historically had this kind of a performance premium and consistency of performance that you pointed out. Yeah.
So let me give you, I just happened to look that up because I was curious, Chris, as to what would the $10,000, what would it have grown to with the ultimate buy and hold strategy? And it was 4.8 million. That compound rate of return is about, I think, 12.6% versus these at around 13 to 14%. But that was still better than most of the portfolios that I looked at. In fact, in a few minutes, we'll see some other nationally known portfolios and how they've done over this same period of time.
I'm surprised.
Yeah.
I'm surprised it's that big of a difference. I would have thought that the worldwide four fund and the worldwide ultimate buy and hold would be very close to the same return. Usually that's what we find.
So that's a good question. We'll take a look at that when we get off here. And if we have to make another comment on that when we get together next week, by golly, we'll make sure we clarify that.
Okay.
But yeah, I've got it. My memory is that it is 12.6 on the ultimate buy and hold. And Daryl, you probably got the compound rate of return of the four fund US only right there in your, if you could take a look at the fine tuning table.
Yeah, the ultimate buy and hold, the US four fund is 13.2, the worldwide four fund is 13.2, and I just went and looked at the ultimate buy and hold, And it is indeed 12.6.
Now, let
4.7,
me,
4.7, 4.8 million for 10,000 invested.
okay, now this is an opportunity to make one other thing very clear. The fine-tuning tables, and I talked about this last week in the fine-tuning discussion, but the fine-tuning tables, their returns are rebalanced on a monthly basis. So if you looked at the compound rate of return of the ultimate buy and hold rebalanced monthly, it's 12.3% versus 12.6% rebalanced annually. So even that makes a difference. There's so many variables in what drives the outcome. As a matter of fact, in a minute, we'll get on to some of these portfolios that represent portfolios that are managed by professionals. And the thing that these numbers aren't going to take into consideration is the 1% those professionals are charging to manage those portfolios. And so that would even have a huge impact on the long-term returns. Okay, onward with this. Now, we're not going to spend any time here on this page. Particularly, I'm thinking about the people who are listening to the podcast. Yeah. But here's the picture. It shows the 1, the 2, the 3, 4 funds portfolios, and it shows their returns every year, each one of them, since 1970. So that you can then, and I think that addresses kind of something you brought up, Chris, and that is on a shorter term basis, we might see more volatility. I mean, certainly 73 and 74, you put those two together, you have a lot of volatility there. But this does give you a chance to compare these. And sometimes it is amazing how different what we think are legitimate, trustworthy, hardworking strategies. I look at 1977, the S&P 500 lost 7.2, I think it's 7.2%. On the other hand, the total world market, in fact, made 19.1%. So they're both large cap blend, but one's all US and the other is a combination of US and international. And the US market, total market, plus the 30% small cap value for that same year actually made 12%, and the total world made 23%. So the differences in 1 year at a time, and that's why I think these tables that show all these little numbers for every year, I know it's a lot to look at, but the idea is that you say, wait a minute, if I get into any one of these strategies, I'm going to have periods where I'm really going to be scratching my head and saying, what's going on here? I mean, how come everybody else is making more money than I am? And that's the nature of any portfolio, and it's important to know about it beforehand rather than afterward. Want to add anything to that, gentlemen?
Yeah, I think the numbers you read for the total US and total world plus small cap value were actually from 78, Paul.
Oh, okay.
But your point is
you're right.
It's still somewhat valid. They're still valid.
Yeah.
When you look at this chart, for those who are looking at the video, this is you almost can't read it on the screen. You need to look at the PDF. But I think the next chart, I think, has a better visual representation.
Okay. I like this. This is great.
Of how you can sort of separate the wheat from the chaff a little bit. And it sort of smacks you in the face a little bit.
Explain what you got there, Daryl.
This is the same chart as 3A1, but what this chart does is it for each one of the 1 fund, 2 fund, there's only 1 3 fund. So for each of the 1 fund, 2 fund, and 4 fund portfolios, it looks at that set of portfolios and says, okay, which one of those 3 or 4 or 5 portfolios had the best return that year, and which one had the worst return that year? And
can I just ask you for sure to make sure? as I read this table, it looks at all of them and it's the best amongst all
Oh,
of them, not just in your own group. Is that
we're
right?
even. We're even. You're right, and I'm wrong this time. Yeah.
It's all right. It's all right.
And
Just,
so,
no,
well, yeah, you're right. It actually looks at the whole set of no nonsense portfolios. You're right, and the best one for your given year is in green, and the worst one is in yellow. And so you can sort of stand back and just kind of look at where's the green and where's the yellow, and how does that work for these or how does that pan out for these different portfolios?
well, and you did something I think is super on this table. At the bottom of the table are all those decades we've been talking about, and you also showed the best and worst decades, portfolios for each decade. And here's
Right.
what I find interesting: the S&P 500, out of the 5 decades, let's call it, they were the best once. They were the worst twice. If you go to the all value portfolio, they were never the worst and they were the best 3 times. And then if you go to the all value US only, and I love this, this is a huge lesson. You were never first. Not one time was that strategy the best strategy of all of these. But what was the number one for the whole period? That all value US only. It was the best for the period, but never the best for a decade, which I think is a great lesson for all of us.
And I think that you've mentioned this before in many of the podcasts, and we've talked about it also, is that this is where it shows that it pays to have a longer term view and your ability to stay with your investments and stay the course, if you will, for periods longer than 1 year or 2 years or 5 years or even 10 years.
Well,
So,
and I think when we talk about how to put a portfolio together for a family, we'll have a chance to show some even better ways maybe to spread that risk. Okay. Now, as we go to table 1B, it's the same process. But in this particular period, this presentation that I was doing for the White Coat Investors Conference, I was looking at their 150 portfolios better than yours. So I used some different strategies that, except in the case of I think the total market US, but I looked at a whole bunch of different strategies, which included the Betterment portfolio, Frank Armstrong, the Coffee House. Frank Armstrong and Bill Schulteis of the Coffee House are well-known national money managers using DFA funds. And so, as you would expect, they are well diversified. And then there's the Sensible portfolios, another organization that has a big following. Then there's the SoFi portfolio. And then I decided, and I was happy that Daryl was willing to do this. Let's throw in a new one that we've mentioned a little bit in the past, but we hadn't made it a part of the regular stuff that we do. The S&P 500 plus small cap value 50/50, so that we could see not only the return, but the risk to find out, okay, we know we're turning up the heat here. What's the impact of that? And by the way, you'll notice on this table 1B on the bottom there, the expense ratios that are being applied to each of these asset classes in this study. And that's important, because this isn't just the index pure, it's index less an investment, an expense to operate that as it would an index fund. Now, to be fair, we didn't have that 52 years ago. There were no index funds, number one, and number two, you couldn't get anything for 0.1%, but now you can. So I think Daryl made that was a legitimate decision to apply an expense ratio, but apply the expense ratios that you would have today as a new investor. So let's quickly look at some of the outcome of this. And here again on table 2B1, we run into the green, the blue, and the red. And I can tell you right now, you're going to find the same kinds of similar down years, the accumulation of the down years, and you're going to see very similar upside potential. I will, if I may, just focus in here for a second on the S&P 500 and small cap value 50-50. Because I think we'll be talking a lot about that strategy. And what I notice is that there were 43 up years and 9 down years. And the total, the accumulated losses during the losing years, they were 121% versus 141% basically for the total US market index. And in 2008, which was a bad year for everybody, that combination of the S&P 500 and small cap value lost 36.9% versus the S&P 500 at 37. So it made me think that there are probably a lot of young people who are trying to make this process as simple as possible, who will see that combination of the S&P and small cap value as a legitimate equity holding. I'm going to go on to the next page unless you guys stop me.
Go for it.
All right, thank you. On the next page, we see the 4 and 6 fund portfolios. And again, we see that the combinations on the upside, on the downside, are very similar. But there is one thing I find interesting. All of the 6 fund portfolios are at Coffee House and Frank Armstrong, again, a DFA advisor, and Betterment. These are all professional money managers. And what have they done to their portfolio? The same thing we've done with the 10 fund strategy, but they've done it with 6, and that is to diversify so that you don't have too much in any one equity asset in your portfolio, asset class in your portfolio. And the bottom line impact of that is all three of those 3 portfolios had returns between 11.8 and 12.5%. So 3 very fine returns. And it wasn't about finding any magic. It was just about expanding the diversification to include some value. And that was the main thing they did. And almost everybody who looks at the academic research has done that. And certainly these folks have. So anything else you guys see on that particular page that that you want to comment on? Nope. Okay. And another page a long page of numbers. Again, that's for you to look at later. These are the annual returns of all of these portfolios. Again, the differences in those annual returns can be absolutely huge. Then we look at that wonderful way that Daryl has noted each year from 1970 through 2021, what was the best and the worst amongst them. And it's interesting to note. In fact, I even counted them up here. Hang on for 1 second, because the differences were substantial. Well, now, of course, I can't find my notes. But what I found was that the number of losing periods, here we go. For the total market index, that's the couch potato. There were 11 green years And for the yellow years, the worst, there were 15 of those. I mean, that is a huge difference. Now, I'm hoping I didn't, hang on, 1, 2, 3, 4, 5, 6, 7, 8. Yeah, I think it's 15. On the other hand, when I look at the S&P 500 in small cap value, there were 14 greens and 4 yellows. I mean, that just says to me that capturing in that single 2-fund strategy, capturing the large through the S&P 500 and the growth through the S&P 500 and some large value through the S&P 500, and putting that together with a small and the value of a small value was a terrific combination in terms of dueling asset classes, and would be very, very simple to manage. Okay, let me move on.
Actually, Paul, can you go
Oh,
back? I just
yeah.
want to make one comment
Please,
on
yes,
that.
yes.
And that's that, and you could see it in the previous chart that had this same color highlighting. The S&P 500 and US small cap value has more of those greens in the early years than the later years.
Mhm.
And you can kind of see if you back way up, there's a pattern here that these investing styles come and go in terms of their ability to deliver the outperformance you expect or not. And some of the rationale or the reason for those early green years is probably inflation.
Yes.
We went through a period of inflation, and value tends to do well
Yep.
in an inflationary period. So if there's a silver lining to the dark news that you hear today in the media about inflation raising its ugly head, it's that, maybe value is going to give us some of that outperformance again, and maybe small is going to deliver some of that outperformance again. Both of them tend to, do well in different market regimes or different, pieces of the business cycle. And you can see that here really, really well visually. I think that's kind of cool.
Well, great remark, Chris. And now I think we have made it through these different portfolios. Hopefully, the lessons are meaningful to people. I am curious now. Do we think we have time here, Chris, to dive into this idea of how would you go about selecting from these different portfolios?
Well, we're at about 50 minutes, so it's your call. Do you want to break it?
I think we can go on. I do.
Okay.
I think we can. So, Daryl, why don't you start? What would you do with all of this information? And you can think as a 25-year-old or a 55 or a 75, whatever you want to do. Lay it on us. What would you do?
Well, there's a lot of things to look at and to consider here. So when I look at I think the first thing to think about is what strategy can I live with? Which one will I be able to stay the course on? And so you can look that compared to what the returns actually show. So if you look at these, if you look at the no nonsense portfolios, there are many choices. There are several choices that could be good. If you look at your compound average growth rates, there are many portfolios above 12, and so that's a couple of anywhere from 1 to 1.5% above the S&P or the total market. So if you look at those portfolios, there are 3 of the 2-fund portfolios, and all 3 of the 4-fund portfolios do better. And so then you think, okay, well, what can I look at there? And if you go and look at the green and yellow chart then, and you look at how those work out, you can say, well, the all value looks pretty good. and the ride is smoother. If you look at the CAGRs down below, the 10-year decadal ride seems to be a little smoother. Although on the other hand, the all value Merriman looks pretty good. It's only 0.1% less, and the ride is a little bit rougher, but not significantly. And you go look at, well, what does the total market or the S&P 500 in the no nonsense case look like? And it says, well, there are some years where it didn't do very well compared to the other ones. So,
So what about
the value where I come down on this then is that some of these value strategies might be pretty reasonable.
So how risky? What is there about an all value portfolio? And let me just share something that I recently was working on some project, and so I decided I would just see what is a growth stock selling for today in terms of PE ratio. What is a growth stock selling for in terms of its price to book? And in both cases, the growth stock was about twice what the value stock was. The PE ratio was way higher. The book to price to book was much higher in the growth. And so there's a part of me that thinks, well, maybe actually, because value companies have been beaten up and aren't as volatile day to day necessarily as the really great growth companies, maybe an all value portfolio isn't all that risky, particularly with this is an all value worldwide, which means you're getting exposure globally as well as in the US, but they're much less volatile companies one by one. And so maybe it's not all that risky. Chris, what do you think?
I think that tilting towards small and tilting towards value does give you a higher drawdown risk, and I think you can see that in Daryl's fine tuning tables. We can go pull up the numbers if you want, but it on a month by month basis, if you're the kind of person who's going to look at your returns, you have to stomach bigger drawdowns. You have to stomach a bigger peak to trough decline in your account balance and stick with it to get those higher returns. That's how you earn them. It's not shown in these charts because they don't show the drawdowns. But if you actually look at the drawdowns for a tilt towards small and value or a tilt towards just value, you'll see it. And so I think when somebody's deciding on their portfolio and their investing approach, they have to assess their knowledge, their risk tolerance. A lot of it's going to come down at the start to what do you believe and what do you know, because education is what's going to give you that perseverance to tolerate the drawdown and stick with it. Right? You need to have knowledge. And then your risk capacity is a different thing from your risk tolerance. If you're young and you've got a big inheritance, you may have an incredibly high risk capacity, but if you're a skittish investor, you may still have a very low risk tolerance. So you have to look at both sides of that coin. And then I think you need to decide whether you want a lifetime auto-adjusting solution like a 2-fund for life strategy, or do you want to manage your glide path on your own? And, that's a pretty big fork in the road. For a lot of people, they're going to struggle to stick with an investing strategy more than 5 to 10 years anyway. So if you're only going to change in 5 to 10 years, it really doesn't matter whether you have a self-adjusting strategy or not, because when you change, you're going to reset it. But I think a lot of investors would be really well served by adopting a self-adjusting strategy and putting it on autopilot and ignoring it. So that's a pretty big choice. And then is it all in one account or is it multiple accounts?
Yes.
Because if it's all in a tax deferred account, well, then you can pick whatever strategy you want. But if you have to have some in a tax deferred account and some in a taxable account, well, now you have to think about how you're going to manage that, how you're going to rebalance it, where you're going to have the bonds. whole bunch of interesting questions there. And then there's personal taste. You know, how much international can you live with? How much US can you live with? I don't think that's going to drive your return so much, but it's going to drive your comfort and whether you sleep at night. And so that's important. And then when you get to the end of all of those things and you've considered them and you've made a choice, you have to figure out, is it going to meet your needs? Is it going to do what you need it to do for you? And if it's going to do it, great. But if not, then you may have to go back and iterate and tweak and twiddle and say, okay, I really don't want to take that much risk, but I need to, because that's what's going to get me to where I need to go. So I think it's a really interesting puzzle. And for a lot of people, like I said, it starts with what you believe. You know, I had parents and grandparents who left me with firm beliefs in investing in the stock market. That made 80% of these choices simple and easy, because I had this starting point that was visceral almost. It was almost a faith-based decision. And I think for a lot of people, they start that way. But for those who don't, then it's going to be an education-based decision. You're going to have to learn, what can I trust in? What can I believe in? You know, what risks are going to feel prudent to me, and then how do I take them and stay the course?
And I think you beautifully threw down the gauntlet here that we need people to take seriously, and that is to look beyond these, go to the fine tuning tables, because the fine tuning tables we have not all of these, because the fine tuning tables are only focused on the strategies that we recommend, because I'm not recommending all of these strategies. We are simply comparing a broader group of strategies. And so there's your chance, by the way, to look at the all value worldwide strategy. And it will show you in the fine tuning table what the worst drawdown was. What was the worst 3, 6, 12, 36, and 60 months. And that would, I would hope, give you a better total picture. But I think, having looked at these tables over and over again, that at the end of the day, yes, you may have a drawdown along the way. For example, I'm only trying to pick out a number that I'm trying to remember. I think the S&P 500, the worst drawdown is around 50%. And I believe with the all value strategy, I think the worst drawdown is around 60%. Now, that probably suggests then there were a lot of times that the S&P 500 went down more than the all value portfolio did, because they both added up to a very similar accumulated losses number. So those are there. They are there to help you make that decision, because we're not sitting there as an advisor would and walking you through these numbers. You've got to do that study yourself. But let's never forget that one of the reasons we're trying to be a do-it-yourself investor is because we want to be paid. We want to pay ourselves that 1/2 or 1% investment advisory fee. And the more you dig in and understand these numbers, I think the greater the probability you will collect that fee yourself rather than pay somebody else. So, I know one thing I was going to ask. What about this? What about if my wife and I, and we're both retired, but we have IRAs, individual IRAs, and we have some Roth and some non-Roth, and then we have some taxable. If you had to pick one, let's just talk about young people here for the fun of it. If you had to pick one of these strategies, and Chris, I mean, you know the two funds for life inside and out, but let's say that we had somebody who could do the glide path on their own. Which strategy here for the first 20 years would you recommend to a young investor?
It's interesting. My daughter just spent some time with me trying to figure out how she should be invested. She really wanted to do it on her own. She wanted to do the trades, the rebalancing, the investing of the latest money that she has in her Roth account. She wanted to, open the brokerage account and learn which buttons to push and how to avoid making mistakes and all that good stuff. And she came up with her own portfolio, which is essentially the international, it's a worldwide version of the S&P 500 plus small cap value in a 50-50 split. The difference is that she has half S&P 500, she's half US and half international. So 25% in an S&P 500 like fund, 25% in the US small cap value, 25% in an international total market, and 25% in an international small cap value.
Oh,
And I think that is a brilliant
great.
place for
That's
her to
great.
be,
Yeah.
because she's very well she has in 4 funds all the things you normally talk about. She's half in large, half in small, half in US, half in international,
Yeah.
half in value, half in blend. And she's very low cost, and it's 4 funds that she can understand, she can manage, and I think she's inoculated herself well with information to
That's
understand that she's going to have different results from what she hears about in the news, and that's okay. And so I think that's an awesome place for her to start. I think it would be a great place for a lot of people to start. Yeah.
Daryl. Can you see another portfolio?
Yeah, I think so.
I think
But,
that
let me go back and say something about that. I think that's very good that she was able to do her own research and come up with her own portfolio. That is tremendous. And that harkens back to what kind of what you said earlier, Chris. You have to believe in something, and you have to believe, what you believe in, and you have to know what you know, or something like that. The difficulty with that a lot of times is a lot of people, or a lot of times it's easy to believe something that's wrong, and it's also easy to believe you know something when you don't. And so the key there is you have to know yourself, and a lot of times that's not easy to do until you have experienced a real serious drawdown. And so I think it's difficult for younger people, I think, especially, who haven't experienced a drawdown, to wake up one morning and look at their portfolio and see that, they had $10 yesterday and now they have $8. What happened? And so until you've actually done the work and believe it, and understand, actually it's not belief, it's understanding how you got to where you are. It's the path you took, and the path you walked, if you will, to get where you ended up. And I think that's key to helping you stay the course, and not be so concerned when you wake up one morning and find out that there's been a little drop in the market, or maybe a not so little drop in the market.
But you've done something, though, Daryl, that I think is just so helpful to young investors. Those tables that you created that show you start with $83.33 a month, or $1,000 a year,
Right.
investing in all the different strategies that we recommend. And I know we're not updated for this year yet, but we will later. And that's their chance to put together, what does it look like during the tough times with any of these portfolios, of the portfolios. And by the way, I believe we've already done the work on an all small cap, worldwide small cap strategy. And we've done not only, I think we've done a fine tuning table with that, if I'm not mistaken. I could be wrong on that one, but basically, by the way, that's what your daughter has done, Chris, but added the large cap international and US blend. I, I think those tables that show what happens over time, adding money a little bit at a time, are really key for these young people to get a sense of what it could be like when they do wake up and it's $8 instead of 10. So
Hey,
Yeah,
Paul,
we
if
have
I
done
can, oh, go ahead, Darrell.
we have done the fine tuning tables for the worldwide all small cap value equity portfolio.
yeah,
It's
good.
It's table B12 in the fine tuning tables.
And what's the compound rate of return, out of curiosity?
For the 100% equity portfolio,
Yep,
it is 14.2.
there you go. I think that's even more than the small cap US only. I think it is.
Well, I just happen to have it here. All US small cap value is 14, right?
Okay, there we go. That's great. That's great. Chris, what do you got?
Yeah, well, I was just going to say there's another measure of risk that we haven't talked about at all during this presentation that I think is really, really important for retirees, and that's the safe withdrawal rate. And what you would find if you cracked my book or if you go back to the fine tuning tables is that these better diversified portfolios that have a mix of the small, the value, and the large have higher safe withdrawal rates than an S&P 500 portfolio or a total market portfolio. And the two fund for life strategies that bring in some bonds as well do very well too. So I think for somebody who's a retiree who's thinking about risk, understanding the safe withdrawal rate capacity of the portfolio that they're in is really, really important, because that's going to tell them basically how close to the running out of money line are you. And that's one that every retiree cares a lot about, right? You don't want to cross the run out of money line. That's the biggie.
Yeah,
That's great.
I would I think looking at the safe withdrawal rate when you're comparing portfolios is a good way to assess the resilience to sequence of returns.
Yes.
It's a poor way to decide how much you should take out of your portfolio when you retire, I think. Because I think for the most part, nobody ever really follows a safe withdrawal strategy that way. That's based on that.
Would you agree that it's a very conservative way?
Most likely, oh yes. But I think
because it's based on the worst case.
The key thing is for it though is not to tell somebody how much to take out. You should. It's most likely a conservative answer. Most probably is a conservative answer. But I think to me, it's a good way to assess resilience to sequence of returns risk, because you're taking money out of this portfolio. And how does it behave when you do that? And you take them out in the down years, and you take it out in more down years, and you have more down years, and you take it out. And so the key thing is how does that portfolio able to recover? And in a way, that's one of the good things about when you look at the telltale charts we've done on small cap value, for example, versus the total market or S&P 500, is it kind of bounces along and hangs in there with the S&P 500, but then all of a sudden, it'll go crazy. You'll have a very, very high outperformance against the S&P 500 or total market over a relatively short period of time. So you can make up your downfalls in the past. You've been able to make up your downfalls or the drawdowns in a over a reasonable investment time horizon of 10 to 15 years.
I've got an idea, you guys, because we got distributions coming up in the coming weeks. And these are, I think, some great topics when we get those tables, and we can lay them out there for people to take a look while we're going through them. So, gentlemen, I appreciate so much what you bring to the table. In 2012, I would never have ever imagined we would be giving this much value to the people following our work. And I really want to thank you. I get emails virtually every day thanking you guys for what you do, and boy, I join them. It's great. Thanks for being here today and to help me. Thanks for doing all these tables and being thoughtful to help people become themselves more thoughtful. So, and by the way, Chris, give out the name of your book, where they can get it, and how much is it?
2 Funds for Life. So simple. 2 Funds for Life, and then the subtitle is A Quest for Simple and Effective Investing Strategies. It's available on Amazon. It's I think it's $9.99 for the Kindle book, which has the advantage that it's in color and you can look at it on a big screen. It's $19.99 for the print version, which is in black and white. And I know some people have said, gee, why isn't the print version in color? And the reason is it would have been a $40 or $50 book if we did it in color, and maybe we will someday. I love the feedback that we've gotten around the book and look forward to more. Yeah.
And where do the profits go?
Profits all go to the foundation.
All right.
Yeah.
Thank you. You're very kind. All right, guys.
I couldn't have done it without the foundation. So it was just paying back.
Yeah, that's great. Well, you both have paid back a ton, and we'll be back here next week again with another one of these. I think we're doing accumulation, if I'm not mistaken, coming up here next week. So stay tuned, and we'll be helping you hopefully have a better financial future. Thanks for listening.
It's Paul Merriman with Sound Investing. Sound Investing, soundinvesting.com, and paulmerriman.com are produced and exclusively owned by Paul Merriman, who is solely responsible for their content. For more information, free articles, mutual fund recommendations, and more, visit paulmerriman.com.